The fintech company Synapse has officially collapsed. Synapse provided banking services to other companies, mostly other fintechs, which means that its failure has wider-reaching implications for the other businesses that relied on it. Last year, Synapse laid off 40% of its staff, and this April, it filed for Chapter 11 bankruptcy. The company tried to sell its assets for $9.7 million to another fintech, TapPay. But TapPay didn't do the deal. That's a huge blow, because Synapse raised over $50 million in VC, including a $33 million Series B led by Andreessen Horowitz. PitchBook estimated that the company was valued at $180 million after the raise from A16Z, and if we run with that number, then basically Synapse tried to sell itself for less than 5% of what it was once worth. Yikes. Now the companies that used Synapse are caught up in its downfall. It's like Jenga, where if one brick comes loose, then the others just kind of tumble too. As TechCrunch senior reporter and equity co-host Marianne Azevedo reported, a teen banking startup called Copper had to discontinue both banking deposits and its debit card accounts. That means that Copper customers lost access to their money. And even though the company is working to make sure they get their money back, it's still kind of a big deal if your debit card account just stops working. Something similar happened at the crypto app Juno. A teacher from Maryland, Chris Buckler, said in a filing, quote, "I am increasingly desperate and don't know where to turn. I have nearly $38,000 tied up as a result of the halting of transaction processing. This money took years to save up." Mainvest, a fintech lender for restaurant businesses, had to shut down altogether. If that's not bad enough, of course, customers can't even access their funds in the meantime. According to Synapse's filings, as many as 100 fintech companies and 10 million customers could be impacted. But a fintech industry expert, Jason Mikula, told TechCrunch that the real number of people impacted might be even higher. Some of those customers do things like running payrolls for small businesses. As usual, when Silicon Valley companies implode, ordinary people get caught in the crossfire. Marianne said that this isn't a sign of doom for all banking-as-a-service companies. But it should be a sign that you can't cut corners when it comes to compliance. I think we've learned by now that move fast and break things rarely works. But I would propose move at a reasonable pace and grow your company without risking severe risk to your customers.